All right, good evening, everybody. We'll start in another, well, it's 6:01 Pacific, so let's begin. Hello, everybody. So my name is Alesh Eisner, and this is the third installment of the Investing Basics seminar. We've had two already. They are up on the YouTube channel, which I'm going to mention, where you can have a look. So why don't we begin? I hope everybody can hear me and see my screen. And so this is Investing Basics. So let's begin. So just to go over what I'm here to do is to give you the basics of investing in personal finance. So in the two previous sessions, we covered some simple investing strategies, looked at different investing vehicles and account types, taxation, which I'm hoping everybody was able to stay awake through. And I think the goal that I'm sort of trying to put forward here is trying to get you to become financially independent. And that includes saving for retirement. And we went over some of the basics, like I said. I want to motivate you to start investing and to educate yourself further by becoming interested, or at least be aware of the importance of investing. Okay. So there's different ways of going at this. We've sort of been covering the mutual fund and exchange traded fund and stocks, even though if you're a beginner, I would steer you away from stocks, individual stocks. And so this third session, I think, is going to be more interesting because I'm going to get into some of the alternative ways of doing this. Now, if you have any questions, there is the chat. So please just type messages, whether to everybody so everybody can see or just to me, and I'll answer the questions as I go along. Okay. So let's take maybe 10 minutes just to kind of fly through what was covered previously in the two previous sessions. And then we'll continue with the content. All right. So as we're going through here, try to sort of identify what kind of an investor you are, how you would like to invest, and if it is through mutual funds, exchange traded funds, or stocks, then you should pick either to go with a financial advisor or to go through a discount brokerage. And if it's the latter, then with the discount brokerage, make sure that you're paying as little fees as you can. So you need to choose the right brokerage according to what you would like to do. So if the discount brokerage charges you fees for buying mutual funds, then don't use that discount brokerage. Use a different one that doesn't charge you fees for mutual funds, for example. Okay. And a disclaimer once again, I am a long-term investor. I'm not going to get you into a get-rich-quick strategy or anything like that. As we covered previously, higher returns usually include higher risk, and that is true with all investments. So just careful about that. So just some caveats. This is not investment advice. It's for educational, entertainment, and demonstration purposes. It's not a solicitation to buy or sell any securities. I've been investing in mutual funds and stocks and real estate and private equity, which we'll learn about today, for over 20 years. And I generally think of myself as pretty risk friendly. I do run a YouTube and a TikTok channel. They're both called Canadian Money Talk. The two previous sessions are up on YouTube, so just Google Canadian Money Talk, and I think to a couple of you I've sent links to the previous sessions as well. And my main goal is to teach investing and personal finance both to adults and maybe at the college level. So, and then I'd like to thank my sponsors, the Oak Avenue Neighborhood Society and Vancouver's Foundation Neighborhood Small Grants Program, who are footing the bill for the meetup.com license and the Zoom license. So thank you very much. Okay, so we talked about that stocks, shares, or equity all mean ownership in a company, and bonds are loans. So there's a difference there. Companies can put out bonds, and bonds, all other things being equal, are going to be less risky than stocks. So they're usually used for ballast in your portfolio, but they also don't perform as well over the long run as stocks do. So it's always the risk versus return. We talked about mutual funds. We talked about exchange traded funds, which are both baskets of investments of all kinds. I'm going to mention something called the MER, or a management expense ratio, which is what the creator of the mutual fund or the exchange traded fund charges you to keep the lights on and to make a profit, and for the administration expenses on that mutual fund and ETF. Actively managed is for mutual funds or ETFs where a human is making the decisions. Passively means that it's following some sort of a formula. Okay, we sort of covered that. Risk is not a bad thing. It's just your own personal risk profile needs to match the profile of the investment. And so the main determinants are you able to handle ups and downs psychologically? Because risk is just ups and downs. It's not a bad thing. It just means volatility. Some people don't like it. Some people freak out. So are you able to handle it psychologically? Are you able to handle it financially? Or are you having to sell something that just went down to buy groceries? So if you're using a financial advisor, they'll give you a questionnaire or talk to you. If you're doing it on your own, you will need to make that determination for yourself. And while the stock market is going up, everybody is very risk friendly. Everybody's on board. It's when the stock market goes down is when you actually determine what risk you can and cannot take. The other aspects of your risk profile are the time frame. When do you need the money back? So if you say I need the money back in a year, then I'm going to suggest term deposits. If you say I need it back in 20 years, then I'm going to say definitely stocks. And the location geographically, that's up to you. And of course the return needed. So if you don't need much of a return, you can be in safer, less volatile things. If you need a significant return, you're going to have to take some risks, but you could also end up with less money than you started with. So that's kind of the trade-off. And there's certain assets which are less risky than others. So you sort of have to be aware of what you're buying. So that would be up to you. Generally closer to home and bigger companies tend to be safer. Further from home and smaller companies tend to be riskier. Okay. Let's see. We talked about the bucket portfolio, which is sort of an interesting study for young people, and it's a very useful tool for people who are nearing retirement. So I would suggest you have a look at that. And on morningstar.ca, there's quite a few articles about the bucket portfolio. This is the index chart, which sort of compares a risk to, okay, anyway, I'll do that, which compares risk to return. So the dark blue line up here, you can see a lot of peaks and valleys, but over the 60-year period, which is what this index chart is showing, you are getting 14% annually, okay? But there's a lot of ups and downs. If you don't like that, then you can get into something safer. So the yellow line, for example, and yellow is a balanced portfolio. So it's 60% stocks and 40% fixed income. I know you can't read it here, but I looked it up here in the legend. So you can see it doesn't have quite as sharp down nor sharp up. And it ends up, okay, that number I can't read. I think it ends up with like 9.5% a year. So, you know, it still makes you a decent return. It's just not as high as the really risky stuff. But if you have a long time frame, you can get into the riskier stuff if you're comfortable with it, as I said. And then finally, let's see, the orange line is the 5-year guaranteed investment certificates, so GICs or term deposits. So you can see nice smooth line as over the years, as interest rates went down, the line started getting a little bit flatter. While in the 70s you had high interest rates, in the 80s you had high interest rates, so the line was quite sharp up or sharper. Now you can see that it's nice and smooth, but the average is 6.3% a year, so you're giving up quite a bit. So if you don't need the return, then that's something that you can get into, or if you have a short time frame. So all of that stuff sort of works together. I'm going over this, I know, for the third time now, but this is a major thing of what you should be investing in. Okay. So I think this is sort of important to go over. This is my view of the world. And so this is sort of how I define different asset types. So I sort of divide every asset into three things: an investment, a speculation, or gambling. All right. So for me, an investment is an asset that has a steady stream of income or cash flow. And examples would be dividend paying stocks, investment, real estate that has a positive cash flow, meaning you have money in your pocket at the end of the year. And the value of the investment is determined largely by the series of cash flows that you have coming in. Now, speculation, I don't mean it to sound negative, but it's an asset that goes up in price because somebody else is putting a higher value on it. So examples would be stocks with no dividends, but let's say they're making a profit and therefore people are bidding up the price, but you need somebody else to bid up the price. Real estate with no positive cash flow, but price appreciation. So if you're not positively cash flowing your real estate, but you're in a good market and the value keeps going up, that's sort of what I call speculation. And finally, Bitcoin and gold. You need other people to bid up the price. So the value of the asset is determined by what somebody else is willing to pay for it, which, you know. And then gambling, just like it sounds, it could go up, it may not go up. So to me, stocks of companies that don't make a profit yet and may not get any price appreciation, and they might actually go bankrupt. Because if you're making a profit, you're not going to go bankrupt. And then real estate with no expected price appreciation if you bought something 100 kilometers out of town. Importance of starting early. This is one of the key things that I want to let everybody know. The best time to start investing was yesterday. The next best time is today. So this is just straight math. This is just compound interest, that if you invest $1 for 40 years at 7%, that turns into almost $15. If you do it for 30 years, it's half that. So the compound interest really is the magic behind investing. Do note that when you get presentations, they always show a nice smooth curve at 7% going upwards. And you saw earlier on the index chart what they actually look like. So it does trend upwards. It's just that there's ups and downs. Low fees are important. Definitely, they do make a difference. Do note, however, that whenever you see any performance numbers on the prospectus or on morningstar.ca, which is one of my favorite research sites, They always show you the performance percentages after the MER, after that annual fee has come off. Okay, market goes up, more green than red, more green than red. More upturns. Bull market is an uptrending market. Bear market is a downtrending market, usually down 20% from a recent peak. So we have more up than downs, and the down markets typically last under 2 years. This chart is a little bit out of date. What happened last year in 2020, that the down market lasted like 4 months or something ridiculous short. So usually they last longer than that, but obviously that was a bit of a strange time. Ways you can invest: you can do a lump sum. You have $5,000, you put $5,000 in. Dollar cost averaging: as you make the money, you put the money in. So you could be putting in $500 every month, and you put the same dollar amount in each month. And so if the asset goes down, you are able to buy more shares, and therefore you're buying more. And then when it comes back up, then you're looking really good. A key component of dollar cost averaging is rebalancing, where every 6 or 12 months you want to look at to see if the proportion of the different investments that you're making is still what you're looking for. And so if you said, I want to be 60-40, 60 stocks, 40% in bonds, and then over the year suddenly you're 70-30, then you would sell some of what went up disproportionately, and you would buy what went down disproportionately. And note that it is just a question of proportion. So both the stocks and bonds in my example could have gone up, both could have gone down, or just one could have gone up, the other one could have gone down. You're just trying to restore the risk profile that you're comfortable with, and for the purposes of your portfolio, you are selling high and you are buying low. So that is as the cliche goes. Okay, and then what do you think about bonds? Okay, so let me answer the question. So bonds are safer than stocks. They are the ballast, like on a ship. They kind of keep your portfolio from flipping over, as to use the ship analogy. If you're not risk friendly, then bonds would be the way to go. They have a couple of issues today. Number one, they pay interest, which gets taxed highly. So if you do have bonds, keep them in your RSP or Tfsa, first of all. And because interest rates are expected to go up, that is likely to have a negative impact on existing bonds. So what that means is a bond is a series of payments, and when interest rates go up, new bonds that are being issued by companies or by government will have higher payments. That means the old bonds, if you want to sell them, and they get traded constantly inside a mutual fund or an ETF, if you want to sell them, you need to discount them because their cash flows are smaller for the old bonds than for the new bonds. And so you need to discount them. So you could actually have a capital loss on existing bonds as they get transacted. So yeah, I don't own any bonds outright. I do own some balanced mutual funds, and balanced by definition means that they do have a bond component. Do note, however, that bonds are seen as a safer investment than stocks. And so when there is a panic in the stock market, such as a year and a half ago, bond values actually get bid up because people take their money out of stocks and they pile into bonds. So they allow diversification, which means bonds act differently than stocks. You don't want your assets, when one goes up, the other one to go down. That's not diversification. You want them both to kind of be going up, but in different ways. So I hope that answers the question about bonds. Obviously, the situation could change. Bonds have done actually quite well the last 10 years because interest rates have been going down. But now let's say that we're going to start raising interest rates, and I mean that's kind of the expectation, but it doesn't mean that'll happen. Then bonds will do poorly. So there you go. I hope that answers. So we talked about lump sum, we talked about dollar cost averaging, and I'm going over this really quickly because this was still in the first. Thank you. Okay, perfect. This was still in the first session. So the other thing you could do is do personal oversight, where you're sort of trying to time the market, and that generally ends poorly. Most people can't do it. Even experts can't do it with any consistency. But you generally need to be you need to be doing the opposite of what everybody else is doing. So you're supposed to be selling when things are expensive and people are greedy. When the market's been going up a long time, people assume that it's going to keep doing that forever, and it doesn't. So when things are expensive, sell. And then when there's blood in the streets, when everybody's panicking, then you should be buying. Okay. You have to make your own choices, and you're trying to outperform the market and all of the experts. And yeah, we all try it. So question, do you think investment in real estate is highly risky in current time? So we'll talk about real estate in this session. I mean, I've been thinking that real estate is overpriced for the last 10, 15 years, at least in Vancouver and probably Toronto. I could probably add to it. I don't know about the rest of Canada. Real estate is a safer investment, but I think it's overpriced. But like I've obviously been wrong for the last 10 or 15 years as well. I do own. I used to own 4. Now I own 2 real estate properties in the U.S. in Las Vegas. I also had 2 in Arizona, which I sold. It's a nice diversifier. When interest rates go up, the carrying costs of the real estate ends up going down. So sorry, the carrying cost ends up going up. Therefore, the prices of the real estate go down. There could, with the expectations of increasing interest rates, there could be a rush on real estate, and it could spike the prices yet one more time. It's not liquid, and therefore its prices don't go up and down as quickly as in the stock market, for example. So it's less volatile from that perspective, but it's not going to double for you in a year, or at least it's unlikely. Okay, we'll talk more about real estate in a few minutes. Okay, so when markets go down, selling is usually the worst thing. Buying more is generally the hardest thing to do, but it's generally the thing to do because stocks are on sale. It's just that it requires a gut check. Okay, I'm talking too fast. I've been over this in previous. Apologies that I am talking too fast. I've been over this in the 2 previous sessions, so I'm just trying to get to new material. Please go on to the YouTube channel and you'll find part 1 and part 2, and then I'll talk at regular pace. Apologies in the recordings. So we talked about RSPs and TFSAs. We talked about, and I don't want to go over all of that because that will take too long. So we talked about the tax table. So in a non-registered account, meaning not a TFSA and not an RRSP, you're using these three columns. I would encourage everybody to look at their own province's tax table. This is from taxtips.ca. And so in a non-registered account, if I'm getting paid Canadian dividends, they get taxed very little. Eligible dividends are for Canadian publicly traded companies, I believe headquartered in Canada. Non-eligible would typically be a Canadian corporation that's not publicly traded. So for example, people own their own corporation, so they can pay themselves non-eligible dividends. They get taxed higher than other things. The worst one is other income, which includes salary, wages, and interest. So yeah, working for a living means you're getting taxed heavily. So then we got into personal finance. So we talked about variable versus fixed rate mortgages, and variable means as the Bank of Canada increases interest rates, your interest rates will go up as well. Fixed means the interest rate is locked in. The interesting thing is that the fixed interest rates are determined in the bond market. So whatever the government of Canada bonds, whatever interest they pay, that is used as the basis for your mortgage interest, but that gets locked in. Open and closed just means open, you can put additional money into your mortgage, while closed means you can just put in the regular payment. You might be able to double up the payment depending on the mortgage. And you might be able to put in 10 or 20% on the anniversary of the mortgage, but otherwise you can't throw additional money in. Generally, refinancing a mortgage will have penalties, especially if it's, well, I think on any mortgage, but it could be 3 months of interest typically. But we talked about credit scores, which is important if you ever want to borrow money, and also to show that you're a responsible consumer. And it just basically, the higher your score, the likelier it is that you're going to pay your bills and meet your financial obligations. So the number of credit inquiries contributes 10% to your credit score. Your credit mix, meaning the various vehicles that you're using to borrow. So you have a mortgage, you have a line of credit, you have a credit card, and you have a car loan. That means you have a good credit mix and that you're responsible with different types of loans. Obviously, don't go out and get a car loan or a line of credit just to improve your score. Your credit history, meaning the length and the age of your profile, contributes 15%. So like I got my first credit card second year of university, and so that gives me good credit history. Credit utilization, that contributes 30% to your credit score, and you want to be out of your total credit available, you want to be kind of in the 25 to 30% at the most. Otherwise, then your score starts going down. And then payment history, basically, do you pay your bills and do you pay your bills on time? Credit cards, if you have trouble paying off your credit cards, don't use them. Credit cards are good for points, but you have to pay them off. And if you're paying 20 or 30% interest, then you shouldn't be thinking about investing. You need to pay that stuff off, because there's no way you can get a guaranteed 20 or 30% return from investments. So it's better to put that money into the credit cards and avoid paying that interest. Pensions at work, defined benefit is is pension, where they promise to pay you certain dollars per month. And if something goes wrong in the stock market, where ultimately a lot of the pension money is sitting and making money, if something goes wrong in the stock market, then your former employer needs to make up the difference, because they promised you a specific benefit, a defined benefit. They could also declare bankruptcy like Sears, and then you're still out of luck. But that's, and so basically defined benefit these days is really only in government and in usually where there's a union or something like that. Otherwise, you don't see them. If there is some sort of a pension at work, it'll be a defined contribution where the employer is going to contribute. They might match your contribution up to a certain point and so on, but they're not on the hook for any shortfalls. Basically, your statement says you have $150,000 and that's yours. If the stock market crashes, you now have $100,000. That's what you're working with. Insurance. So life insurance is only if you have financial dependence. There's no reason to insure a child whatsoever. But if it is somebody who's making money and there's going to be somebody who's going to suffer financially, then they should have life insurance. Generally, all the experts say get term life insurance, which is only life insurance, and it's generally cheap. And you should try to have enough of a benefit that if you pass away, you would pay off your mortgage and, let's say, 10 times salary benefit. Okay. Whole life, permanent life, universal life, all these names, that means there's an investing component to the life insurance. There's life insurance, and then there's an investing component. It usually costs a whole bunch more than just the term. Generally, at least all the ones that I've seen tend to be for investments. So I would really check the numbers. I'm not going to take you through this, but you basically get a printout like this, or if you don't, you should ask for one, and you should really see how your money's doing. And if they tell you you can borrow money against this cash value, find out how much of an interest rate you will be paying. Okay. And segregated funds are mutual funds with an insurance wrapper. And it's generally where they say, if you hold this for 10 years, we will top, if it goes below a certain number, like it could be 75 or 100, then we will top you up. And the message here is that very rarely over a 10-year period does the stock market go down. So they're sort of insuring you against something that is extremely unlikely to happen. The second number, so you have the segregated fund, it's whatever name is usually the mutual fund, and it's a segregated fund. Okay. It's a segregated fund, and then it has these two numbers after it. And so the second one is that if you pass away, remember it's a life insurance product, then they will top you up to this second number. And so, if you buy it and you bought $10,000 worth, and then you pass away 6 months later, and the stock market happened to go down, then they'll top you up to whatever it is that you contributed. Okay, so this is sort of where we left off. And so becoming financially independent. So let me talk about that first before we sort of delve into how to get into it. So there's a concept of, it's sort of a movement begun by a gentleman familiarly known as Mr. Money Mustache. The movement is called FIRE, F-I-R-E, which means Financially Independent, Retire Early. And it just means that you don't have to work anymore, that you are financially independent and you can live off your investments. So The retire early part is sometimes discussed, and the reason is that if you're 30 years old, you don't really want to sit for 50 years and watch Netflix all day. Like, people need something to do. So financial independence is that if you don't want to work anymore, that you can not have to work anymore. But generally, financial independence should be sort of aimed for by everybody, because when you retire, you do need to be financially independent at that point, or you can't stop working. The retirement, yeah, if you're 60 or 65, then that's fine, but not if you're 30. So a lot of the FIRE people were people who hated their jobs. And generally that's not what you should be doing. You should be switching careers most likely. If you hate your job so much that you don't want to do it anymore, you should be changing careers, because people get bored, some people sooner than others. But you might need a second career. That's basically it. So the financial independence, though, is super important, because if you want to take a year off work to travel, if you need to take care of your parents, your children, whatever it is, if you want to spend time with family, financial independence is what you want. And so these are some suggestions. And I am at this point financially independent. I don't have to work anymore. I haven't worked for a significant period of time, and I'm able to live off the dividends and the rents. So I kind of hope that everybody's going to be in the same boat that I am. Okay, so becoming financially independent. First thing, you need several diversified streams of income. If you only have one income, which is your salary, that means you have to keep working. You're not financially independent. You're stuck. So whether you're a landlord, whether it's dividend income, whether you're a contractor where you work 3 months out of the year, for example, lately you can be a blogger, you could be a YouTube content producer, you could publish a book online, training courses, online selling, whatever it is. In some cases, I kind of think, well, you're not retired, you've changed careers. Like some YouTube content producers or online, if you're selling stuff on Amazon or on eBay, you just have a different career. You just become self-employed. So ideally, you have a sufficient income from various sources not to have to work or do what you want to do. So if you really want to work with animals, for example, I want to volunteer at the SPCA. Financial independence lets you do that. FI is about choice and independence, meaning you can take time off anywhere. It means freedom, and it means that you can quit a bad job rather than being forced to stay in it, and you don't immediately have to get another job. So one of the things you might want to do is have an emergency fund of several years. Earlier, I mentioned that it's good to have a 3 to 6 month emergency fund anyways. If you're currently working and you get laid off, you don't want to be selling your investments to live on, because those investments could have gone down at the same time as the economy got worse, which is why you got laid off. So yeah, you want to have those living expenses, and if you want to feel safe, have $100,000, have 2 years worth of living expenses. Obviously, that's up to you. Can I move this? Hold on. Okay. So it would be good to know what expenses you actually have, so you know what income you need and what that emergency needs to have in it, that emergency fund needs to have in it. So I would really suggest tracking your expenses for, like, I track mine religiously and have for years. If that's not something that you enjoy, do it for 3 months and then extrapolate it for a full year and add in stuff that you pay once per year if it's not in those 3 months. So that way, you know your burn rate, so you know what your emergency fund should be, and you know what income you can live on, both early on and then finally in retirement. Keep in mind, things could change once you actually retire. Once you're not working, your expenses typically go down. You could maybe get rid of one of the cars. You're certainly not paying quite as much for wardrobe and for travel, for the commuting to work and so on. The other thing is on retirement, there tends to be what do they call it? They call it the go-go years, the slow-go years, and then the no-go years. So when you're first retired and you're still able to, you travel, so that increases the expenses. Then you sort of get that out of your system and you settle down. You know, you might be spending more time with family, so you still, you know, need to go and visit them and so on, but you're not going all over the world. You know, you sort of settle down a little bit. And then in the no-go years, however, you're not traveling or doing very much anymore, but your medical expenses might go up significantly. Probably more in the US than here in Canada, but you still may need long-term care and so on. So it's important to sort of budget for that and sort of know what your expenses are. So for the early retirement, or just retirement and not running out of money, we have the 4% rule. So this is something that that was coined in the Trinity study back in the 90s, where somebody looked at an investment portfolio and they sort of looked to see how not to run out of money for 30 years. So they kind of assumed you're going to retire 60, 65, and then said, okay, you're going to live for 30 years and you don't want to run out of money. And I believe it was a 60-40 portfolio, 60% stocks, 40% bonds. And they said that if you withdraw 4% every year, adjusted for inflation, you have only a minuscule chance of running out of money by the end of the 30 years or by the end of your existence. So that's kind of become a thing. I've read different articles where they say, well, you can actually be more generous and you could probably make it 4.5 that you could withdraw, which I'm sure a lot of people were like, yay. And then I read an article recently that said, well, you should sort of make it 3.3%. And if you're retiring early, you might want to aim for 3%. And so it of course depends on what, you know, what kind of person you are, and nobody knows the future. But so the financial independence number is sort of the reverse of the 4% rule, where you do your yearly spending and you divide it by the safe withdrawal rate. So if you want to spend 50,000 per year and you want to use the 4% rule, you're basically dividing by 0.04 or multiplying by 25, which means 25 times 50,000 means you need a cool 1.25 million to reach 5. So yeah. Now let me say here, that seems like a daunting number to most people. Please don't throw up your hands and say, okay, well, if I can't make it, then forget it. I'm not even going to try. You're going to be thanking your future, your past self in the future, when you have a portfolio that you can draw money from to add on to CPP and old age security and so on. So basically, when you turn 65, even if you haven't become financially independent prior to that, you're now able to take advantage of the various support systems that we have in Canada. And whatever money you do have saved will just be gravy, even if you don't have financial independence prior to that. So please don't say I can't. There's no way I can make that. So just I want to throw that out there. Years to FI is your FI number, so that would be that 1.25 million minus amount already saved, divided by what you're annually able to save. That's a sort of a very rough estimate because it's not actually including any growth. So as far as once you do reach that age of 60, 65, if you start taking both the Canada Pension Plan and Old Age Security at 65, you can take the CPP earlier, but then they pay you less, and you can take both of them later, as late as 70, and then they pay you roughly 40% more. But if these numbers are for 65, you start taking them, and so they add up to $25,000 a year at this point, which a lot of people max out Old Age Security because that's just dependent on residence. You max it out after 40 years of being resident in Canada, and it's prorated. Minimum residency for Old Age Security is 10 years, and then you get a quarter, right? 10 divided by 40. Canada Pension Plan is entirely on how much you contributed into it. When you're working, they're taking roughly 5% of your paycheck, and your employer is matching that by law. So if you worked your whole life and you've sort of maxed it out, I think it maxes out around $40,000 or $50,000 earnings. If you've maxed it out, then you will get this number, but very, very few people actually max it out. So even if you were to max it out, 25 grand a year in today's dollars isn't great. So I would definitely encourage you to save and invest earlier on. If you're below 18,000, there's guaranteed income supplement, which will top you up to 18 grand. So if you have nothing saved, you weren't paying into your CPP, and you're only going to get Old Age Security, you're only going to get 11,000, then GIS will top you up to 18. The government's trying to make sure that you don't live under a bridge, but they will definitely not make it a lifestyle of luxury, which I think is fair. So becoming rich and financially independent, the number one determinant is your savings rate. It doesn't matter if you're paying slightly higher fees, slightly lower fees. If you're putting away 5% of your gross income every year, that is not going to cut it. If you're putting away 50%, that is going to be the number one determinant of how much you have saved, how much you have invested, and your financial independence. Okay. And from personal experience, it really starts to add up. Like you put away small amounts, especially if you're young, you put away small amounts, and suddenly you have 50,000, and you're like, oh, okay, all right, let's pay a little bit more attention to this. And suddenly you have 100,000. It's like, oh, okay, because you're putting in more money, and at the same time it's compounding. So this is why I'm saying start now, start early. Whatever age you are, it's never too late. It's always going to be better than doing nothing. And then number two is your asset allocation, meaning, are you putting money into stocks? Are you putting into bonds? Are you putting money into real estate? Bonds don't have the same performance as stock over the long run, as I mentioned previously, but they also don't have the volatility. But that is definitely going to have the biggest role in determining your net worth. So don't depend on analyzing, and I want the lowest fees and so on. The fees are definitely a part of it, but make sure that's not what you're focusing on, and you don't get paralysis by analysis, where you're researching the best mutual fund or the ETF and you never pull the trigger. Also, I found that if you were to invest all your money into one single stock and you're hoping, you know, to have it quadruple or times 10 or something like that, that will work out so infrequently that it's just not worth doing. So I've always tried to get a diversified portfolio, and it's served me well in the long run. Then again, I've also, I believe I'm a good saver, so there's that. So I've had that working for me. Okay, where are we? Okay, so that sort of ends that section. Any questions or comments or anything like that? Investing in real estate means buying more than one house, doesn't it? No, well, theoretically, you're investing in real estate when you're living in it, your primary residence. Buying more than one house means that the second, third, and fourth are investment properties where you're going to put a renter in there. And that's where I said you have to have positive cash flow, meaning the rent needs to be higher than the sum of the mortgage payments, the property taxes, the insurance, strata fees if it's a condo or a townhouse, incidental repairs. Some people will put into their calculations, there's spreadsheets you can download, and some people will put into their calculations a savings for when the fridge dies. So they know that the typical fridge lasts for 10 years. So they say, okay, the fridge is $600. So every year I'm going to subtract from my positive cash flow $60 to be saving up for that fridge. And after all of that, you should still have a positive cash flow. And then I would count that as an investment in real estate. But I've had philosophical discussions with friends who said, I'm not counting my primary residence as part of my portfolio because I have no intention of selling it. So it depends how you look at it. Again, the question was, investing in real estate means buying more than one house, doesn't it? And I guess I would say yes, but some people could say, well, my primary residence is an asset. I count it in my net worth, and it's going up. So I'm going to say that that's an investment as well, because you're not collecting any rent and you're basically just spending money on it. You could make the argument that it's not a very good investment. You could also argue that you're saving money by not having to pay rent somewhere else. So you could also look at it that way. It just ends up being a mental and philosophical exercise. But yeah, good question. Okay, so here's some portfolio examples. So these are real. I took out the actual names so as not to give you the idea that I'm giving you financial advice. But so this is what I'm putting into my Tfsa every month, into a Canadian index fund. And remember, index is something that's just following passively, is just following a formula. So a Canadian index fund is $100 US index. Currency neutral means that it does not get affected by US versus Canada dollar movements, that the US dollar versus Canadian dollar movements don't affect it. So that one I'm doing 158, and that's just following the S&P 500 index. And then the third one is international. So that's EFI. So that stands for Europe, Australasia, Far East. And MSCI, you're going to see these in all sorts of places. MSCI just means Morgan Stanley Capital Investments. That's just the company that's putting together this index. And because I am a believer in foreign markets eventually outperforming what we have happening in Canada and in the US, because they have an increasing young population and still a lot of poor people that are being pulled out of poverty. So that's why I'm putting in $200. And if you're wondering at the weird numbers, if you multiply them by 12, they add up to 5,500, which is what the TFSA limit used to be before they raised it. And I am just too lazy to fill out another form to increase the numbers. So I don't know if you guys can see this. Okay, so this is I got all of these off of I believe Canadian Couch Potato, which is a website where so they have Canadian bonds, Canadian index, US index, international index. So pretty much like my TFSA, except I don't have any bonds. And then if you're conservative, then you're 70% bonds and then 10% everything else. If you're cautious, balanced, assertive, aggressive is only 10% bonds and then 30% everything else. So you sort of have to say, I think I'm one of these, and then these are kind of the percentages. And then remember to rebalance, like I said previously. Toronto Dominion has a good E-series index funds, which are low MER. They used to be available only in if you had the Toronto Dominion trading account, but I understand now they're available elsewhere, and they have a much lower MER, so I would recommend them. So question is, how do you feel about target date index funds? So target date mutual funds, just to generalize it, basically means they are saying you are going to withdraw your money as of this date. So you could have a mutual fund that is dated 2040 in 19 years, okay? And so basically what that does is they will slowly transition you into less risky assets as your withdrawal date comes along. So if I were to buy a 2040 target date fund today, it would be all stock, right? Because you have a long time frame, like we talked about with the risk, and you have a lot of volatility, but you don't care because you're not getting the money now. But as the date approaches, so I'm making this up, so maybe 10 years out, they put in 20% bonds. Okay, 5 years out, now it's going to be 50-50. I'm totally making this up, but they sort of do that for you. I'm okay with them, to answer the question. They charge you slightly higher MER for doing this service for you. They also rebalance within the mutual fund. If they're targeting 50-50 and it becomes 70-30, then they'll go back and rebalance it for you automatically. So that's another service that they would do. But they'll charge you a somewhat higher MER, not 1%, but they might charge you more for this rotation of slowly substituting in safer assets. You also lose control in that they're doing everything for you behind the scenes. I mean, you can look at the prospectus to see what the percentages are, but if you own the stuff individually yourself, then you can fiddle with it on your own. And if you're feeling good about something, then you can leave it while they're just going to do it, do it automatically and dispassionately, which might be a good thing, actually. The other thing is, be careful, because remember, you don't need all your money at the same time. If you're planning on retire at 2040, you don't need your entire portfolio in your checking account right at that point. So you will theoretically be buying 2040, 2041, 2042, and hoping that it would produce roughly $50,000 in each one, right? So if you're planning to be retired for 30 years, you might need to have 30 of these target date funds. So they're okay. I mean, they deserve checking out, but I'm just, the loss of control would bother some do-it-yourselfers. And the fact is that you would need multiple of them. That's all. And you could probably do the same thing yourself and save some of that myrrh. But yeah, good question. So here's a question: would it be feasible to put $100 per month to my TFSA? So that's a very open-ended question. Let me know if I didn't answer what you're asking, okay? So TFSA, at this point, you can put in $500 even just per month, even if you had maxed out your limit previously. So based on the limit, you can certainly put that in. If it depends what your goal is, obviously. If you're trying to have it for retirement, then depends. If you're 20, then that might be okay. If you're older than that, then you probably need to bump that up a little bit. TFSA is good. I mean, anything that comes out of it is tax free. So investments in there are growing tax deferred, and then when you pull the money out, tax free. So TFSA is a good vehicle, especially if you're maybe not making a heck of a lot of money. You're not in a high tax bracket, so you might want to, TFSA is a good way to go because you're not paying much in tax in order to get that $100 to put into your TFSA. And also putting money into an RSP would be, well, it wouldn't be giving you much bang for your buck if you're in a low tax bracket. So I don't know if that doesn't answer your question, then please let me know, and I'll try again. So going back to kind of possible portfolio. So here's another one. Again, you can see from the color scheme that it's from the same website. So Aggregate Bond Index. So I think this is a worldwide bond index. Then they have Fitsi, which is a ratings agency. They create indexes. So this is basically all stocks in Canada. And then you have MSCI again, all country world, excluding Canada. So you have worldwide bonds, you have Canada only stocks, and then you have rest of the world stocks. And you have same kind of thing, conservative, your 70% bonds, all the way through to aggressive, where you're 10% in bonds, 30% in Canada, and then the rest of the world 60%, which would include the US, and then the rest of the world, obviously. Just a quick FYI, Canada stock market is 3 to 5%, depending on the year, of the overall world's capital. US is roughly 50, and then the rest of the world obviously is the other 45 or 47. Okay, so mutual funds. So I do this also every year. This is just a copy out of my trading account. So every month, these are mutual funds, and I took out this. I took out the exact symbol, but I do international equity. I do a tax effective balance. So that does, the balance again means that there's a bond component. I do Canadian, and then I do worldwide small caps, meaning small companies tend to have more of an upside, but also because they're young and vulnerable, they could also go bankrupt. So this is kind of what I'm doing, and it adds up to 1,000 that I do every month. It's just automated. They just pull the money out of my account. Are we okay? So going back to the questions, I am in a, so this is the same person as asking about the TFSA. I'm in a low tax bracket, but a saver. a question, what about mutual funds in gold stocks? Yeah, you can certainly buy gold. So let's talk about gold in general. You can certainly buy gold either through an exchange traded fund, meaning you don't have the physical coins. Some people want the physical coins if there's a zombie apocalypse, maybe. I talked to a gentleman some years back who was of a certain age, and he said during World War II, if you wanted to eat, you had to have gold. So there you go. But as an investment, gold is it's not as safe as people think, and it's not also necessarily an inflation hedge as people think. Gold can be quite volatile. It is quite volatile. It just ends up working it tends to be kind of a fear index where people are afraid of something, so they start selling stocks and they put the money into gold. So you can buy the gold index, meaning the tracking the price of the bullion, which is like $1,900 an ounce right now. You can buy that through an exchange traded fund, or you can actually buy the gold producers, which I think is what the question is talking about, mutual fund and gold stocks. So there's certainly exchange traded funds which can get you into gold stocks. There's mutual funds which can get you into gold stocks. Easy Google. Okay. I'm not a gold person myself. First of all, of what I said previously is that it is quite volatile. It's not safe. It's just that it works differently than stocks do. So it is a diversification. People, when they get afraid, they go into gold. It doesn't really hedge against inflation. The other problem I have with gold producers is that gold is a commodity. Okay, so the gold gold producers, the miners, they don't have anything unique. They're price takers. So they could do quite well if gold is doing well, but if gold is going down, they will do poorly, and they're stuck with it. While if you have a company that has something unique, Microsoft, for example, then they can set their own prices based on whatever product or service they're providing. So I prefer companies like that. Having said that, many a financial advisor and expert say that you should have 5% of your portfolio in gold. But please don't think like my mother, who thinks that that's safe. It's not. It's not. It's also not going to quadruple for you. Gold seems to be, for ages, seems to be in a range like between 1,200 an ounce to about 2,000. So you can still make money on it, obviously. Okay, so it sounds like I answered the question. The answer is yes. You can certainly buy mutual funds with gold if you're a gold person. The other problem is, as I mentioned previously, is that you need other people to bid up the price of gold for you to profit, and for the stocks of the miners to go up, because gold doesn't have any utility, right? It just sort of sits there and looks shiny. You can't eat it, you can't build on it, you can't live on it. It's not even used in industry, unlike silver, which is actually used up in industrial processes. Gold usually goes to jewelry and some maybe high-end electronics, but it generally doesn't go away. Okay, so mutual funds, sort of a good segue. So I like Morningstar .ca. Make sure you get the .ca version. What do you think about buying a farm? Ooh. Okay, well, we're gonna get to real estate in a second. Well, okay, let's talk about a farm. To be honest, I don't know anything about farms. I may not be the best one to ask. There's always a chance that you'll be approached by a developer who will want to put a subdivision there, and it'll be awesome. As far as farms, I hear different stories about farmers. Some seem to do really well and be rich, even though they still drive the pickup truck. And then some farmers seem to barely keep their head above water. So I don't know what to tell you. I don't know the investment process for a farm, whether you would actually want to live there and do the farming yourself, or whether you would lease the land out to somebody. That's another way of doing it. There's some farmers who sort of want to cash out, but don't mind to keep farming. So you can buy their land, and then they can pay you a lease every year, and they can just stay on the land. So yeah, there's different ways. I don't think I know enough about it to answer the question about buying a farm being a good way to invest. So anyway, back to mutual funds. What you want to do is look on Morningstar, and they have a star system, and it's from 1 to 5. 5 means that they're outperforming the rest of their peers, other mutual funds in their category. So if you get a 5-star mutual fund, then it's in the top 10% of the performance of other mutual funds in that category. You're also looking for it to outperform their index. And an index is a benchmark of similar investments, right? Like, it wouldn't be fair to compare Canada to the US. So you would want to compare a Canadian mutual fund to a US index. But if you have a US mutual fund investing in US companies, then comparing it to a US index is fair game. So a good mutual fund, and there's not that many, unfortunately, because of the fees, they will outperform the ETFs which are only tracking the index. ETFs are typically, and I talked about that earlier, ETFs typically just follow an index passively. Mutual funds typically are actively managed, and so they charge fairly high fees. And then quite a few of them don't beat their indexes. So you have to look for good ones. All the results, as I said previously, is after the MER has come off. And so you're looking for 4 or 5-star funds only. That means that they're beating 70 or 90% of their peers in the same category. And you want to make sure that the mutual fund is beating its index. Be aware of the MER, but it's the performance that matters. Mutual fund loads are additional fees. I'm not going to go through each of these. Make sure you're not getting a deferred sales charge or a low load. What those are is that if you sell it before 7 years is up or before 3 years is up, they will charge you. So if you sell it, I'm making this up, if they sell it within the first year, they'll charge you 6%. If you sell it in the second year, they'll charge you 5.5%, and so on, all the way down to 0 after 7 years. So be careful of them. A lot of financial advisors like to sell these because they usually get a 5% commission on these immediately from the mutual fund company. And that's why there's that fee, is they want to make sure they recoup that commission that they paid to the financial advisor. So here's an example: 5-star mutual fund. This is off of Morningstar. The blue line here is the fund. The red is the index, so you can see it's beating the index handily. And the yellow is the category, meaning other mutual funds in the category that's called Global Small / mid-cap equity. So you can see the majority of the other mutual funds in this, in the category are not beating their index. And this mutual fund is beating both the index and the other mutual funds. So that's sort of what you're looking for. And you can see the difference is quite significant, sadly. So there you go. So you get all sorts of great information on Morningstar. Yeah. So you'll note the MER is still pretty hefty, but it is lower because this is a do-it-yourself mutual fund. The MER is still quite hefty compared to an ETF. The ETF, however, would be following the red line because the ETF would passively follow the index. And if the exchange traded fund has any sort of a MER, that would mean it's slightly underperforming the index and it's constantly underneath it. The reason here is good stock picking. And the MER is lower than what the guys in yellow are paying, what the other mutual funds are charging you, because this is a do-it-yourself, so they don't pay any commissions to your financial advisor. So a financial advisor would not sell you this mutual fund. Go on Morningstar and find 5-star mutual funds, and you'll get stuff like this. Now, of course, if you want a financial advisor and you want them to help you, and MER stands for management expense ratio, and so it's a fee that automatically comes off. Here's the price. Here's the share price, 1880. It automatically comes off the price. You never see it go. It's not a line item. Yes, management expense ratio. It's not a line item on your statement or anything like that. It's just what the mutual fund company is charging in order to keep the lights on, to pay their employees that are making the decisions, and of course to make a profit. So this particular one also has a minimum investment of $5,000. Hidden charges? No, there shouldn't be anything else. No. These would be the only sort of hidden charges, which if the financial advisor sells it to you this way, they could sell you front end, which will charge up to 5% up front. While what you're looking for is no load, or front end zero, meaning it's front end, but it's zero. What is the rate of return on the index and the 5-star mutual fund? Well, let's see. I don't think I have this in the screenshot. Yeah, I have this annually. But like the fund 2010 made 16%, 2011 I guess was, yeah, 2011 was a bad year. It actually eked out a profit while the category was 15%, sorry, yeah, 15% lower, and the index was 7% lower. Yeah, no problem, Darlene. I'm happy to help. Then again, since 2009, like it wasn't difficult to make money in the stock market. Like you see, 2013 was a good year for the mutual fund, but so same for the index and for the other mutual fund as well. But this mutual fund still beat them by 11 and 13%. Just a little bit of education, right? Like I feel bad for people who don't educate themselves and who go to a bank and say, hey, I have money to invest. Somebody told me I should start investing. And they go for 20 years and they're putting their money into something that's making the bank more money than it is the investor. And of course, it's the investor who's taking all the risk as well. So yeah, just showing a little bit of interest, I think, is important. But yeah, like I know, like, you work a long day and then you come home, and if the family pounces on you, like, the last thing you want to do is analyze it. But I'm sort of a money nerd, and I belong to a couple of investment clubs, and I enjoy it. So anyways, we're gonna run way over time here, but let's keep going. So how to begin? Have an investment thesis is usually a good way. Have goals, have measurable parameters, and like I told you, sort of my investment thesis about emerging markets. So I try to compare my investments to this. Like, I want cash flow, so I like dividend payers, and then I like growth, which is why I like the emerging markets. So that's sort of my thesis. I confess I don't have it written down anywhere. And then you can kind of use two approaches. You can do top down, where you have the investing thesis that ties everything together. So yeah, here we go. Poor countries, low average age, grow fastest as people are pulled out of poverty, and they want to drink a Coke, they want to play on their iPhone, and they want to drive a BMW. I guess. The other thing, you could do bottom up, where you're just kind of picking individual investments that are going to outperform the overall market. You can do that, and then you just have a bit of a mishmash of different investments. But as long as it makes you money, there's no problem. Determine your risk profile. We kind of talked about that. Decide on a portfolio. Are you going to use mutual funds, ETFs? Are you going to use one-time big purchases, or are you going to do a monthly automated purchase? I would advocate for the monthly automated, especially, and we talked about this last time, especially if you're somebody who spends every last dollar in their checking account. Have the money come out first, and then feel free to spend whatever you want. Choose a discount brokerage that will give you the least fees for what you want to do. So if you want to do a TFSA, and they say, well, if you don't have at least $20,000 in the TFSA, we're going to charge you $100 a year administration fee, then that's probably not the brokerage that you want to go with. So do your research before you pick one. It's filling out forms, and there might be fees if you want to switch to a different brokerage. Yeah, so yeah, check the annual fees, minimum investments, and see if they have no commission for the brokerage account. RSP, TFSA, RESP, pick an account type. I mentioned last time, I usually think that if you're sort of in a low tax bracket and you think you're going to make more money in the future, TFSA is a good vehicle. But as you're sort of nearing the top of your career, an RSP will give you a good bang for your buck. So I even made a little diagram. I'm not going to scroll up to it now. You fill out your forms, you pick your stocks, mutual funds, whatever. You may have to send them a void check, or just fill out your checking account, the routing number and all of that. I think it's all done online now. I don't think 12 years ago I had to send in a whole bunch of paperwork. I think you can do it all online now. If you want to do regular withdrawals, you have to fill out a pre-authorized payment form where you pick what you want to be putting the money into. And then if you're doing one-time transactions, some brokerages, you can buy first and then transfer the money in later. Other brokerages like Wealthsimple, you have to transfer the money in first. It has to arrive, then it has to wait for 2 business days, and then you can buy with it. So it depends on the brokerage, but that's how that works. Okay, fun stuff now. Everybody's awake, and my apologies to the people in the Eastern time zone. So alternative investments, so collectibles, classic cars. Most cars depreciate unless you have a 65 Mustang. which a friend of mine parked in my garage for a while, so I got to walk around it gingerly. Stamps are good, comic books are good, especially if they're in good shape. Baseball cards, if you didn't play with them at school. Art, I started investing in art, my friends. I'm very excited. Star Wars toys in original packaging. So if you took Boba Fett out and played with them, you're not going to get very much for them. But those are good alternatives. And the other thing is, they slowly inch up. They generally don't go down. Okay, so if you have the right whatever it is, you can make fairly decent money. But they're a good diversification. Okay, real estate. So I'm going to keep an eye out on the chat. So where do you go to? Alistair's your print. Where do you go to evaluate your prints? I don't know. A friend of mine is an artist and she does prints. And she that's I don't know. I mean, an art expert would be the where do you go to evaluate your prints? An art expert would be my suggestion. You could try to Google them. Yeah, I don't know enough about art. I just wanted something pretty on my wall that would also appreciate. So yeah, that's not my thing. Neither are the classic cars, frankly, or the stamps. Okay, on to something that I know a little bit more about. Apologies, I just don't know. You bought what you liked. Yeah, for sure. I mean, art is meant to be enjoyed. It shouldn't be. I mean, prints are going to be significantly lower price than the actual original art. It usually allows the artist to sort of mass produce with there's a little embellishment, I believe, that goes onto the prints. So it allows the artist to mass produce their art, to get it out to more people, and to make a, oh, okay, if they were limited, then yeah, then that's good. Yeah. Okay, so real estate. First rule, money is made on the buy, not on the sell. So this is a very cardinal rule, as well as the positive cash flow one, which I'll get into in a sec. So you can buy real estate from a motivated seller. Okay, and I'm not advocating ambulance chasing here, but you can help somebody out of a tough situation. So somebody has to move for work, somebody's getting divorced, whatever it is. You can find a motivated seller who will say, okay, for a quick close, no dependencies on being able to get a mortgage for cash. I can have you out of here in a month or 3 weeks if you want, right? You're helping somebody get what they want, and you're getting a discount. But when you're selling the real estate, there's very few motivated buyers. Like, so somebody who's moving into town, they can rent, they can buy somebody else's property, they can buy 5 kilometers over. So you basically need to buy something cheap, and you give yourself a margin that even if the real estate market goes down, you're still doing okay. Generally, you would want to deal directly with the owner if you're buying real estate for an investment. If you're dealing with a realtor, this is now on the open market. It is going to be fully valued for whatever the market is doing at that point. So you're not going to get a great deal if you're going with a realtor, okay? Because the realtor is also going to want their share and make their commission, but they're basically going to put it out there for everybody to get the best price. You can do creative deals when you're buying, where like I said, this is for cash. You're going to be out of here in 3 months. You can start the rest of your life. You don't have to stay with deal with your ex for however long while the place is selling. So the creative deals could be, there's maybe somebody who's house rich but cash poor, who has their only asset is their house. So you can make some sort of a deal with them where they can stay in their house. They're going to treat it like their own until the day they die. And, they might be paying you rent or whatever it is that you want to figure out. So this is the most important. Generally, if you're buying through a realtor on the open market, you're not going to get any great deals. And then it's going to be that much harder to make it positively cash flow. So here's a method of how to participate in real estate, and that's wholesaling, sometimes called bird dogging. I've never done this myself, but it's basically when you have a lot of time and no money. And so what you do is you find real estate deals for investors. So you meet investors in whatever shape or form. You have your Rolodex, and then you go around neighborhoods and you hand out business cards and you talk to people and you say, hey, if you're ever wanting to sell your house, give me a call. I can get you a deal, or I can make a quick cash purchase. And 1 in 100 will call you, and then you go to your Rolodex of investors and you say, hey, I have a price here. Sorry, I have a house here. And then you can get paid either a commission where you get a percentage, or you can say to the owner, well, we're gonna be here for the price, and then to the investor you say we're going to be here. So you basically make the spread for your time. You get the house under contract, and then you can find your investor. So you don't have any money, but you have time. You talk to people. You drive around neighborhoods and you talk to people mowing their lawns. You can do flips, which I'm sure everybody's sort of familiar with. You buy a property, you put some lipstick on the pig, you make it prettier, a coat of paint. One of the flips I participated in, we moved a staircase and to cut a wall to open it up. You can either do it on your own and or you with a partner. So I was part of a joint venture where I provided the down payment and the good credit to get the mortgage, and then my partner found the house, and then he did and or supervised all the work. And so you can do them in various ways. You generally want to do them very quickly because you're paying interest on the money that you borrowed, and you're obviously in an upward trending market. That's helpful. If it's a flat market, you're just adding value by what you did to the house. So that's fine. Both of them, I did 2 flips. The first one, my partner and I split about $30,000, so we made about $15K each, and that went about as smoothly as it possibly could have. The whole thing took 3 months, so that was very good. The second one, we subdivided a property and sold 2 properties separately and fixed up the existing house. That took an inordinate amount of time. Dealing with City Hall was just painful, and it went way over budget. And so, yeah, I'm not going to do any more flips. But some people make a living that way, and if you know what you're doing, and if you're unlocking the value of the property by either subdividing it or actually condensing, you can certainly do that. And I've done videos on the YouTube channel about my experiences if you want to know more. So buy and hold, I think, is what most people sort of see as real estate investing. Again, make sure that there's positive cash flow, that you have money left over at the end of the year. This is for two reasons. Though probably more than two, but I'm going to mention two. First is, you don't want to be subsidizing a total stranger to live in your property, because then it's not really an investment, then it's a speculation, like I was defining previously. If the other thing is, you can subsidize the renter when you're working, and to do a couple of $100 a month. So the question is, I believe you mentioned real estate was a bit of a headache, and maybe you won't do it in the future. Can you go into that a bit at some point? Sure. So if you're subsidizing the renter, it's okay if you have a job, and if it's a couple of $100, no big deal. You might be a little bit surly if they have too many demands. But these are like long-term investments. Like if you're doing buy and hold, like this is in years. And so bad things happen. And so I kind of look at each investment as a black box. I'm putting money in, and I want more money coming out. I don't really care what the black box is doing inside it. And the thing is, if you get into trouble, if you lose your job, if you're going through a divorce, hard time, whatever it is, the first thing you start looking for is for stuff that's costing you money to throw overboard. And so the saying goes, if you don't have a positive cash flow on a property, you are eventually going to lose it. Because in those years that you're keeping these things, and I've had the investment properties thing since 2009, some of them. And so that's a long time, and bad things will happen. And if there's no positive cash flow, like you're like, okay, the market's gone up, I'm getting rid of it, right? It's costing me money. And so lastly, joint ventures, which I sort of talked about a little bit, when you have a partnership where you contribute money or work. You could have a partnership where one person's a realtor, so then they don't charge you a fee. You could have somebody else who's a property manager, so they do it on the side, and then they want to cut. You have to have somebody with money and the good credit rating to get the mortgage, and then somebody who knows construction, somebody who interior decorator who looks and says, oh, we can really open up the space if we take out this wall, and so on. So you can do joint ventures. Obviously, if you can do all of that yourself or pay somebody, you may end up being better off. So to answer the question, yeah, real estate tends to be a headache. You talk to anybody who invests in real estate, and they'll have some horror stories for you. I had a bee infestation because somebody who was working on the roof neglected to close up the roof, and the bees kept coming back. And then that place basically sat empty for like a year and a half, until somebody climbed up on the roof and said, oh, you're missing 2x3 yards of tile. So I had a flood. And the property manager terribly underestimated the repairs. So the tenant actually paid for the flood, and then the property manager kept wanting more money. And I'm like, you got the money from the tenant, right? So he wouldn't take her to court. Oh, but once the furniture was moved, and once the carpet was taken up, and I'm like, okay. Never really had trouble getting renters. So 2 were in Phoenix and 2 were in Vegas. Sold the 2 in Phoenix already. And so as a Canadian, additional difficulties, I have to do US taxes. I had to send my original passport to get this ITIN, International Tax Identification Number, so I could file my taxes. Constantly having to think ahead so as not to convert to US dollars to Canadian. And then it's like, oh, there's an expense. Okay, convert back to the US. Sending checks and keeping fingers crossed that they arrive. You know, I'm the type of person who wants to get 3 quotes on the insurance for the property. So now multiply that times 4 plus my condo in Canada. So, you know, it just ends up being a lot of work. The other problem was, and this won't happen to somebody in Canada, is that back in the day, they were in the US, they wouldn't lend money to foreigners. And so I had to buy everything for cash. So there was no leverage. And leverage is when you're borrowing to invest. And so you're making a significant amount of money as a percentage off of the down payment. I had to pay for everything with cash. So basically these things were returning me 3-4%. And just, you know, every time I get an email or a phone call, oh, the air conditioning's out. Okay, that'll be another $1,000. I'm just like, oh my gosh. And so I prefer to buy Canadian dividend payers that don't send me emails. So question or comment, I think invest is challenges, but there's best way to earn money. Yeah, for sure. So so Thao is saying that investing in property has challenges, but it's the best way to earn money. I want it to be 50-50 personally. I want it to have 50% in stocks and mutual funds, and then 50% in real estate. And as I was buying up the houses in the US, and 2 of them were bank owned, by the way, so they were great deals. They were a third of what they were the previous time they were sold. So I made out like a bandit, and I tripled or quadrupled my money in those 10 years. So I'm not going to complain about not making money. I'm just saying from a and this is personal opinion, that there are a lot of trouble compared to the alternative, which I can get. So real estate, you know, I have a couple of friends who are in the construction business, and they want no part of stocks. They like real estate. And then I have another friend who just wants to live in real estate and then just wants to be in stocks. So everybody's different. You sort of have to right size it for you. As I said previously, real estate tends to be a little bit more stable because it takes, you know, 90 days to sell, and as opposed to pressing a couple of buttons. And so they don't go up and down quite so quickly. They certainly can go down though. We had that here a couple of years back in Vancouver. And don't talk to anybody in US about 2008 because, like I said, like those houses dropped by 60-70%. I'm assuming you had to pay capital gains on your flips. Can you explain how much it was? So yeah, yes, yeah, both in the US. In the US, they actually will withhold money from foreigners as well. I guess the IRS got tired of chasing people that didn't live in the US for their taxes. So now they withhold over a certain threshold, they withhold money during the sale. Yeah, and on the flips, yeah, absolutely, you have to pay. Yeah. Can I explain how much it was? Like I told you, the first one I netted $15,000, so it wasn't a heck of a lot. I can't remember what tax bracket I was in, So yeah, I might have paid maybe, because capital gains is half the rate of what you would pay in taxes on salary, then I still made out okay. The U.S. and Canada, by the way, have a tax treaty, so whatever taxes I pay in the U.S., I don't have to pay a second time in Canada. So yeah, point well taken. Some people just like real estate. It can definitely have its challenges. You can have a great renter that'll be in the same place 10 years, no problem. And then you can have somebody who's constantly late on the rent. You also hear horror stories, and I'm sure those are very infrequent, but it's somebody who has no intention of paying rent, and they just know that it'll take you 6 months to get them out. Um, British Columbia is very renter friendly, so the laws really make it tough to get somebody out, for example. So anyways, I'm hoping I commented on both the questions there. So private equity, this is sort of fun. So private equity is companies that are not publicly traded, so they cannot go to the stock market to get money, but they still need money to grow or for particular investments. And so they go to private investors. It's usually organized through a salesperson who I believe is getting anywhere from 6 to 8% commission. And so you give them money, either general money or for a specific project. The salesperson has 30 different projects at any point on their shelf, which they tell me that they checked. Since they get commissions off of them, I don't know if they check them all that carefully, frankly. I'm in about a dozen at this point. One of them had gone really bad, and another one, about 2 years ago, they said, we can give you your money back, and it's been going on for 10 years, sorry, for 2 years, and I've gotten absolutely no money from it. One that I've done, I've done some videos. You can take a look on the YouTube channel. One that I like is about a car wash. For those of you who are local to Vancouver, out in Coquitlam by the Coquitlam IKEA, there was a Boston Pizza which got shut down. This company which builds self-storage places, which I've invested into 3 of them and seen 0 cash flow because one isn't filled up yet, and the other one is still being built, and the third one is still being rezoned. And I put money into the 4th one, which was a car wash, but they typically do self-storage places. And so they're frequently real estate related. They don't have to be, but I invested in a car wash down in Arizona. These are sort of very vanilla. You just write a check. You don't have to do anything. I biked out to the one in Coquitlam and to kind of have a look and see what the progress is. And the Boston Pizza got torn down, but then again, I gave them the money 9 months ago. So there's that. Generally, the minimums are $5,000, $10,000, $25,000. The money is tied up for, depending on the investment, anywhere from 2 to 5 years. If you can get out early, there's usually penalties, or there's limits of every quarter how much money they'll give back. Sometimes they need the investors to be either eligible or, what's the other one? There's 2 types of investors, but it basically means you have at least like $1 million net worth, or you make 200,000 per year, that kind of thing. Eligible or accredited. Eligible is, let's say, $500,000 in investments, and then accredited is $1 million. I'm making the numbers up, but it's something like that. Because all they do is they give you a 70-page prospectus, and they're poorly regulated or not very regulated. And so the first hint you'll get that something's going wrong is when the monthly cash flows that they promised you stop. There's no disclosures like they have in the stock market. So I did do a couple of videos. Please have a look. I think they're good ones. So yeah, on the Canadian Money Talk YouTube. Startups. These are companies where somebody has a great idea and they need money to implement it, or just to quit their job so they can work on it full time. They'll go bankrupt very frequently, but if they do well, then you can do very well. Private debt, either directly or through a website. I haven't done this. You can lend money to people. I would certainly diversify. I wouldn't lend all of the money that I have to invest to a single person, because it could be outright fraud. You can kind of check on their credit rating, but yeah, I would definitely say be careful there. Commodities, gold, silver, I think we sort of talked about this already. And then foreign exchange, there's foreign exchange traders. Basically, I think the US dollar is going to go up. I use my Canadian dollars to buy US dollars. If I'm right, US dollar goes up. When it reaches whatever peak I think it's going to reach, I sell the US and I buy Canadian dollars with it, and I have a profit. So those are just some. Okay. So I'm going to go through this really quickly. This is sort of comparing different types of investments, okay? I know I'm probably going way over time. I'm hoping this is useful. So I'm going to go vertically. So downside risk protection, meaning what's the risk? How much money could you lose? Appreciation, how much money could you make? Leverage, meaning can I borrow in order to invest? Liquidity means can I get out? Not get out with my original money, get out when something's going wrong. What control do I have? Is there cash flow? Am I getting money in my bank account every month or every quarter? How is the taxation, and how is it against inflation? So stocks, downside risk protection, not so great. The stock market could drop 30% and individual stocks could go to zero. I had one stock go bankrupt and it was worth zero. I just wrote it off. Appreciation, stocks will outperform most things. Leverage, you can get a margin account and you can sort of borrow to invest in stocks. Liquidity, absolutely. You can sell it in 30 seconds and you can have your money in a couple of days. Control, not so much. You get disclosures, but you can't tell the CEO what to do. Cash flow, yeah, if it pays dividends, then you can get cash flow in your pocket monthly, quarterly. Tax benefits, yes. Capital gains are taxed at half the rate as wages and salary. Inflation hedge, yes, mostly because of their good performance. It'll beat inflation, but inflation will harm most or some stocks, let's say. So bonds, remember, are loans, fairly decent downside risk protection, but they will lose value as interest rates go up, as I said. Otherwise, they're relatively safe. They don't really make that much money. Leverage, pretty much the same as stocks. Liquidity, yeah, you can get out of them fairly well. Control, again, next to none. You'll get some disclosures. Cash flow, yeah, you get the interest payments. Tax benefits, not great because the interest is taxed as salary. Inflation hedge, no. In fact, bonds will lose value with inflation as the interest rates go up, like we discussed. Real estate, you could overall say that real estate is pretty safe. I mean, there have been a few exceptions. Appreciation, I think Thao is going to disagree with me. real estate goes up at the rate of inflation over the long run. That's what the experts say. You can point to houses in Vancouver which are getting 8% over the last 20 years. Sure, there's been an amazing run. I think there's going to be a pullback to the mean, to the average. Leverage, yeah, absolutely. There's a prototypical leverage play where you put down 20% as an investor, and any money you make off of it is basically multiplied by 5 because you're borrowing. You're borrowing to invest, and you're making decent money off the amount that you put down. Liquidity, not really. It takes 2-3 months at the very least to sell. You can certainly get a home equity line of credit against real estate to get some money out, but that doesn't let you sell the asset. Control, yeah, you control the renters somewhat, but not the city or the neighbors or the damage and repairs to the home. So that's, but yeah, I mean, the renter, like I said, if you get a bad one, cash flow depends on whether the real estate is cash flowing. Yeah, if you're paying out more than you're getting in, then that sucks. Tax benefits, you have tax write-off, but this is what's bad, is that the rent is taxed as salary. Appreciation, of course, is taxed as capital gain, so it's taxed at half that rate. Inflation hedge, yes, yeah. Commodities and real estate are sort of your prototypical inflation hedges. Real estate tends to do quite well in inflation. Private equity that we just talked about, downside risk protection, yeah. The ones that are secured by real estate, maybe a little bit better. But the one that went really bad, like I put in $10,000 right now. I think if they actually let it go, I'd get about 1,500 back. And I think the company that took it over is just basically going to milk it, and all of the avenues at their disposal are suddenly going to dry up right when the money dries up. And so all they're doing is delaying me being able to write it off as a capital loss. So it's okay. What does it mean, tax write-off? Well, like when you make money, you pay taxes on it, depending on what it is. If it's salary, you pay quite a bit of taxes. If it's capital gains, you pay less taxes. Dividends, like I said before, are taxed the least if they're Canadian dividends, Canadian eligible dividends. And so a tax write-off is the opposite, is when you have expenses, you're able to write them off against income. It doesn't mean that the expenses are covered by the government. It just, whatever tax rate you're in, you get that discount. So if you're in a 30% tax bracket and you need to fix a leak and you pay the plumber $500, then you're able to write $150 off your taxes. So that's a tax write-off. Yeah, most welcome. Appreciation for private equity can be quite nice. Some of the initial ones that I invested in were promising, in the teens per year. Leverage, no, you can't really borrow against it. Liquidity, absolutely not. Like I was saying, you can really count on the money as being gone. I invested in some real estate through private equity that they were going to. Okay, all right. Well, thank you for joining, Darlene. If you have any questions, try to get a hold of me. I invested in some real estate that they were going to sell to oil companies, and this was back 6 years ago or what have you, and the money's just been dead money. I'm hoping that they'll at least get me my own money back. Control, not much, but what's kind of cool is that my salesman has on multiple occasions when I had questions set me up on phone calls with the people running those investments. So that was kind of cool. Try doing that with the CEO of Apple. Cash flow, yeah, it depends on the investment. I'm picking investments that will pay me money on a monthly or quarterly basis. Not that many of them have, but yeah. Tax benefits, yes. So again, the ones that I've picked, you put in $10,000. They're paying you on a monthly basis, and that's lowering the adjusted cost base. So let's say over the 5-year period, they pay me, I'm making this up, they pay me $2,000. So now that's the return of my own capital back to me. So now my cost basis is 8. And then let's say that when the apartment building or whatever it is that I invested in gets sold, it gets sold at 15. I pay capital gains on $7,000. Okay. If somebody didn't understand that example, I can do it again. So for me, that's super tax efficient. On the cash flow, I'm not paying any taxes, and then I'm paying capital gains on it when they sell it. Inflation hedge, meh, maybe. Okay, let's go through these really quickly. So startups and businesses. Downside protection, absolutely none. In fact, most of them I think will end up failing. Appreciation, yeah, if you get the right one, you could do really well. You certainly can't borrow for them. If they go public or something, you can certainly get your money out, but otherwise no. Control, depending on if you have controlling interest or not. Cash flow, probably not. Tax benefits, yeah, you could get some tax write-offs. Inflation hedge, yeah, if it does well. Gold, downside risk protection, no, it's quite volatile. In certain situations, it can do well. Appreciation, sure. Borrowing against it, not so much, just in the same way as you can for stocks, I guess. You can do margin accounts in your brokerage. Liquidity, for sure, you can get it out, you can get money out, you have absolutely no control, no cash flow. Tax benefits, pretty much the same as most other investments. Inflation hedge, I don't, like I said, it's not really. I've read articles where they've done studies and it didn't really work as an inflation hedge. Cryptocurrency, Bitcoin and all that other stuff. Downside protection, no. I mean, you invest at the wrong time and you lose 25% within a week. Appreciation, certainly. Certainly, if you time it right, you can make really good money, outstanding money. Leverage, nah, not really. Liquidity, yeah, you can certainly get your money out. Whether the government doesn't know about it or not is a different question. Some people think they don't have to pay capital gains. Control, none at all. Cash flow, nope. No, you'd have to sell it. Tax benefits, yeah, depending on whether you report the capital gains or not, I would certainly suggest you should report them. Inflation hedge, it doesn't benefit from inflation, it just acts completely different from inflation. You could sort of make the same case for gold. So anyways, I hope that sort of gave an overview. Financial advisors, well, they get paid usually by commission, where they get anywhere from 1/4 to 1%. These are sort of your bank mutual advisors. Some by the transaction, which means that they'll buy and sell stuff for you just so they get a commission, which is terrible conflict of interest. Some get paid as a percentage of assets, and then some will get paid by the hour. These are really the only ones that don't have a conflict of interest. They'll do a know your client. And then based on that, they'll usually give you a preset portfolio. Fiduciary financial advisors are supposed to do what's best for you. Suitability means they just have to sell you something that is suitable according to the 20 questions that you answered, but it doesn't have to be the best for you. So those will usually end up being investments that will pay the most commission to the financial advisor. Financial advisors have to add value. Today, people can research their own investments and they can buy the investments themselves. A financial advisor has to do what I'll go through in a sec, but they need to do a financial plan and they need to update it yearly, ideally, or if you get married, if you have a child, that kind of thing. They should rebalance and update your portfolio. They should teach you. They should check in on insurance. They should check, do you have a will, and refer you to somebody. They should check in on the mortgage with you. They should sort of not just look after the mutual funds that they sold you. They should have an overall view of your entire financial existence. Probably the highest value added is when they talk you out of selling when the market's gone down. They prevent emotional decisions and they educate you. And they should recommend investments that perform well. But like I said, you can probably do that research yourself. And I think I gave you the avenue to do it yourself. You should always compare investment performance to its benchmark, whether you're running your portfolio, whether you are running your portfolio, or whether it is the financial advisor who's running it. Don't look at it in absolute terms. Don't look at it just whether it made money or lost money. So as an example, if I walk into my financial advisor's office and they say, congratulations, you made 15% this year. Everybody goes, yay, I made 15%. The follow-up question should be, what did the benchmark do? What did the market do? What did the Toronto Stock Exchange do this year? If they say it did 20, then you're like, well, you're underperforming. Like, what's going on? And they should have a reasonable answer, like, well, we're looking at it in the long term. Your investments put money into something that isn't doing well right now, but we're expecting it to take off. Fair enough. Going the other way, if you walk in and they say, well, sorry, you lost 5% this year. I say, how much did the market lose? Oh, the market lost 10%. You're doing a great job. Like there's no escaping the losses sometimes, but you want it to be better than the benchmark. So what do financial advisors do? They shouldn't just pick the mutual funds for you. They should have all of your life together financially, and they should show you blind spots and problems. They should tell you to do nothing during market crashes or buy more, ideally. They should make you stick to the plan and remind you why it is important and what the plan is. They should do risk management for you, meaning if this goes down 20%, are you going to be okay with it? Or if you're not, then we need to get you into something different. They should help you with your budget, so you have money to invest. They should ensure that you're saving into the right account types and have some sort of a tax strategy, right? Like one of my friends who's at the top of his tax bracket, he finally, after me and his girlfriend nagging him, started investing. He just went to a random financial advisor and they put him into a Tfsa. So he's paying lots of taxes to get the after-tax money to put into the Tfsa, and he's getting no tax relief. He should have been in RSPs. Like, I was excited that he started investing, but he was in the wrong tax account. And the financial advisor just, it's easy. No, no, it depends. All of this depends. They should have a plan of how you're going to take the money out later. Like what's the game plan as you get older and closer to retirement? They should at least be conversant with the tax laws. They should point out opportunities, point out weaknesses. They should look at the big picture for you. Like sometimes you're too much in the weeds and you're just concerned with your own life, and you don't know that you're missing this or that kind of thing. They should rebalance your portfolio, like we talked about a couple times now, and they should definitely prevent the emotional investing decisions. And in all honesty, be willing to pay for great financial advice. Do the math on this. Like if you're starting out, then you know, if you have $20,000 to invest, get you're either going to do it yourself, or if you get a financial advisor, you're probably going to have to do the commission model until you build up your portfolio. But if you have 2 million, then go to a financial advisor that you're going to pay by the hour, and they'll do a financial plan for you, and they'll check on your portfolio, and they'll charge you $5,000. You don't want to pay that $5,000 when your assets are 20,000, but you should every couple of years be willing to do that for your $2 million portfolio. So yeah, just it's very likely to help you in the long run, is what I'm saying. Robo Advisors, it's basically stuff done online. They'll put you into low fee ETFs and index funds. They will also charge you a percentage of assets, but it's not going to be 1%. It might be, depending on the amount that you have, it'll be a 0.25%, 0.5%, that kind of thing. It's all done online. You probably won't have access to a live human. You might have access by email, or if you pay extra, you might be able to get on the phone with somebody. So it's just a different business model. Any idea what the rate of return is on a robo advisor? It depends on the assets, right? They're going to have a portfolio of low fee ETFs and index funds, so it's just going to follow the index. Markets in general over the long run return, let's say 8, 9, 10%. So I wouldn't expect the robo advisor to get you anything else, right? It's not anybody trying to outperform the market. They're just trying to match the indexes. Even if you have a financial advisor, no one will take care of your money as well as you will. So know enough to be dangerous if you're totally disinterested. I always tell people, you worked really hard for your money. Don't just blindly hand it over to somebody who's frankly trying to make money off you, right? That's what the banks do. The financial advisor's trying to put food on the table. Like, you can't fault them for getting a commission, but just be aware of it and have high expectations, like I talked about here. If they just put you into a prefabricated portfolio, then you need to be paying them really low fees, like here. But you know, people go to a financial advisor at the bank. They have a nice office, a big desk, they wear a suit and tie, and you think that they know the future. They don't. Nobody does, obviously. They make you fill out the questions, or which is faster than actually talking to you and getting to know you. And frankly, at the bank, they probably have 500 to 600 clients, right? So they're going to have 2-3 meetings a day. They don't know everybody. They just got to know what your risk profile is and what portfolio they have you in. They're not going to do anything custom for you, and they're certainly not going to help you with your budget. That's just the business model. And because a lot of the mutual funds don't outperform their indexes, that's why people started doing it themselves and getting into ETFs, which just match the indexes. So, okay, home stretch here, guys. So information, Morningstar, I mentioned previously, Every morning I go on there, and they usually have 2 or 3 articles, and I'll usually read them. They're a great source, and they're impartial. Some of the articles, they interview a fund manager, so it sounds a little bit like advertising for that mutual fund, but I sort of grin and bear it. You can definitely do mutual fund research. Just go to the mutual fund tab, and they have 5-star funds, so you can click on that and you can get some really good mutual funds. Stock market research is a little bit less. You might have like, you can do a lot of stuff for free. I think for stocks, they end up making you pay for it. Stock Chase, they dutifully record what experts say on the Canadian BNN, the Business News Network, and they started doing CNBC, which is the American equivalent. And you can search by the stock and by the ETF. They don't have anything for mutual funds, but you can see what the expert has said. And so I subscribe. I entered my portfolio, and so when an expert has said something, next morning I'll get an email about the stocks that I'm interested in or that I own, and they transcribe it fairly accurately, which is good, about what the expert said about that stock. Money Sense, it used to be a magazine which I loved, not a paper publication anymore. Personal finance, investing, lots of great articles. I would also subscribe and get their emails. There's lots of great articles. Some are, this is what's happened in the past week. Some are more general. So Canadian couch potato, low cost portfolios, some good reading. I got those from the sample portfolios. I think I got from there. BNN Bloomberg, that's Canadian business news. At the gym, I just listen to their videos on headphones. Okay, last piece here. Reading list. There's so much stuff. I'm just gonna give you some standouts. The Automatic Millionaire. Synopsis is invest every month. Automate it. And if you're the type that spends everything that's left, then you're okay with it. But automate it, and that's what's automatic. Rich Dad, Poor Dad, not my favorite reading. Robert Kiyosaki's a bit of a blowhard, but it basically says you have to, you sort of need to invest in things that go up in value. So synopsis is, what makes you money is an asset. What loses you money is a liability. So a car, unless you're driving for Uber, is a liability. It's on the left-hand side of your balance sheet. It counts towards your net worth, but it costs you money. It saves you time. Your primary residence, same thing, liability. Investment property, stocks, those are assets. And then the other thing is he defines your wealth not by your assets or your net worth, but how long can you live without working? Because that kind of combines your income and your spending, or your assets and your spending, right? Like you could have somebody who spends lots of money, and if they're not working, then 2 months without working and they're in serious trouble. While somebody who doesn't spend very much, can live a long time. Wealthy Barber Returns, very user-friendly, kind of palatable stories teaching basic stuff about investing, mutual funds, that kind of thing. The Millionaire Next Door is by 2 marketing PhDs who were contracted by a company that wanted to market to millionaires and wanted to see the profile of a millionaire. And it wasn't the rich looking person, driving a fancy car and $5,000 suit and Rolex watch, that person is probably up to here in debt. It's the person who kind of looks normal, but they drive an older car, but their house is paid off, the car is paid off, their suits are $500, and they're sort of living within their means. So that's there's a very quotable piece in there where they were talking about the people who look rich but actually aren't. And one of them, I guess, must be from Texas, because he says, we have a saying about these people in Texas, big hat, no cattle. So people who look rich but aren't, they have the giant cowboy hat, but they don't actually have any cattle. So that, my friends, concludes this. Apologies for taking much longer. I like to talk. Any questions before we sign off? Anything that's kind of coming to mind? Next Tuesday, 6 o'clock again Pacific, I'm going to have a question and answer forum. So it'll be a session just like this. So bring your questions if you don't have anything pressing right now. Can we buy crypto on Tfsa RSP? Crypto in a Tfsa or the RSP? I think through. Yeah, short answer is I'm not sure. That might be an easy Google. I seem to remember, so Canada was the first one to come out with an exchange traded fund for crypto, but I seem to remember something about not being able to buy it in one of these accounts. So yeah, please Google that. I don't know. I'm not interested in crypto at all, and so I sort of skip by things like that. I just seem to remember something. What's my rate of return on your private equities? Bad. So the private, well, I shouldn't say that. The private equities, I like as a diversification, because they're not publicly traded, and you can't really get out of them. So they act completely differently. There were a couple which I got my money back for. Actually, I think it's been 3 now. And I remember one which I put in $15,000 and I got $25,000 back. Another one, which was 4 properties which were being rezoned into one big property that they were going to put a couple of apartment buildings on. That one just got sold to a developer. They already gave me a $20,000 check to get my money back, and now they're calculating the actual profits, and they're going to send me a second check. So that one, assuming they will actually send me something, that one's done quite well. As far as cash flow, there is one called Centurion REIT, or Real Estate Investment Trust. They're all over Canada. They own multiple apartment buildings all over Canada. They you could set your watch by $200 dropping into my checking account every month. 15th of every month, there's $200. Their website also says my investment is appreciating. I haven't tried to actually sell it for that price. You have to sell it back to them. The one horror story that I mentioned, that's obviously bad. So the ones that have sort of come to some sort of a fruition have turned out okay. As far as being a good source of cash flow, so far, not so much. Like I said, I put significant money into the self-storage places, which have been 3, and then a car wash, which is the 4th one. And I think I put about 20 grand into each. And from that, I haven't seen a penny. So no cash flow. Their business model, and again, take a look at the video. The business model is that they they get the money, they build it, they fill it up, obviously with people needing self-storage. They refinance it, and they will then pay me 8.5% interest back to the day that I gave them the money. And then they pay me 8.5% for probably 4 to 5 years. Once they find a decent buyer, then they will sell it. They will give me my original money back plus I think there's like a 70% profit sharing. So it's a bit complex. They're all long-term investments. Like, I consider the money completely gone. Obviously I track it, but I consider it gone. So they're sort of fun. Before COVID, by the way, there used to be dinners where they would present 2 of these opportunities. So you'd go to a very nice restaurant. Sometimes there'd be like preset menus. Sometimes just pick anything. I'm like, lobster and steak it is. And the nice thing is you get to hang out with rich people, which is kind of cool. Usually old rich people. But if you get the right table together, you'll start talking about it, and everybody's kind of sharing what they're investing in and what they like. And it's kind of a cool atmosphere. I mentor students from Simon Fraser University, and I've had a chance to bring a couple of them to these meetings. Starving students, they just like the dinner, if nothing else. I'm kidding. And so, I think they kind of got a lot out of it, just kind of being able to rub elbows with kind of people with experience. So I thought that was kind of cool. So second question is, are you still high on Alibaba? The market is down a bit. Alibaba stock continues to go down. Yeah, this is a little bit beyond the scope of this, but yeah, I still like Alibaba. I'm gonna see what happens. Like, I think most of the risk there is political, and that sort of comes and goes. I think the Chinese government rattled its saber enough to scare Jack Ma into cooperating and not running his mouth. And I'm hoping that like Alibaba just has an amazing future. I think there's been some competition now, and I mean, they're still profitable even in this environment. So I do think I try not to convert money, and so I usually wait until I have 5,000-6,000 US coming from the rent, and then once I have that, I throw that in. So yeah, I might do that soon. So yeah, good questions. Any other questions? I've apparently been able to talk for 2.5 hours. My apologies to anybody. I'm going to stop sharing. Okay, some people stuck with me. Good for you. Yeah. Okay. Any other questions? Thank you for your attention, and yeah, you guys have a wonderful weekend as well. Thank you, Thao. Any others? Yeah, you're most welcome. I enjoy talking about investing, and if I can help people out, again, do check out the YouTube channel, Canadian Money Talk, and I'm also on TikTok, also Canadian Money Talk. So check it out, and otherwise, I'm gonna wish everybody a great Sunday, and I will see you guys on Tuesday. Bye.